Your money is becoming less flexible, even as it grows in number. You can earn more, save more, even invest more, yet your control over it is quietly narrowing. Transfers take longer than expected. Access depends on approval. Value shifts without your consent. Something beneath the surface is changing, and it is not being announced. It is being absorbed. The system you rely on is not failing in obvious ways. It is tightening in invisible ones. Most people believe money is stable because it has always appeared to be. Banks feel permanent. Currencies feel official. Institutions feel structured enough to be trusted. This belief is reinforced by consistency. Your balance updates. Your payments go through. Your salary arrives. Everything appears to function. That appearance creates confidence, and confidence becomes dependence. But the stability people trust is not the same as control. It is the result of layers built to manage behavior, not preserve freedom. What people notice first is friction. Transfers delayed, fees increasing, limits appearing where none existed before. These are treated as minor inconveniences, temporary adjustments in a complex system. But friction is not random. It is introduced deliberately, often quietly, to guide how money moves. What feels like a technical delay is often a structural decision, and those decisions are not made by the individual holding the money. Beneath that visible friction is a mechanism most never see. Modern money is not just currency. It is a system of permissions. Every transaction passes through checkpoints. Banks verify. Networks approve. Regulations filter. At each step, control is exercised. Not over the money itself, but over its movement. And movement is what gives money its function. Without movement, value becomes static. And static value becomes constrained. People adapt to this without realizing it. They split accounts. They follow rules. They accept delays as normal. They adjust behavior to fit the system rather than questioning the system itself. This adaptation reinforces the structure. The more predictable behavior becomes, the easier it is to manage. And the easier it is to manage, the more control can be applied without resistance. The system does not need to force compliance. It is learned. Over time, this creates a form of lock-in that is difficult to detect. Your income is tied to institutions. Your savings are stored within them. Your transactions depend on them. Leaving the system is not impossible, but it becomes increasingly impractical. Every alternative feels less convenient, less secure, less recognized. So the system remains in place, not because it is perfect, but because it is embedded. This is where crypto enters, not as a replacement, but as a contrast. It does not begin by improving the existing system. It begins by removing assumptions. What if money did not require permission to move? What if ownership did not depend on custody by an institution? What if value could exist without centralized validation? These are not upgrades, they are structural shifts, and they expose what modern money has quietly become. Bitcoin, introduced by an anonymous figure known as Satoshi Nakamoto, did not solve a visible problem. It revealed an invisible one. Trust in traditional finance is external. It is placed in banks, governments, and systems that operate beyond individual control. Bitcoin redirected that trust into code, not because code is perfect, but because it is transparent. Its rules are visible, its limits are defined. Its operation does not depend on approval from a central authority. What people see in crypto is volatility, prices rising and falling unpredictably, markets reacting to sentiment. That visibility draws attention away from what matters more: the structure itself, a decentralized ledger where transactions are recorded without a single controlling entity, a system where ownership is defined by access to a private key, not recognition by an institution. These are not features. They are departures from the existing model. This creates a different kind of behavior. Instead of relying on intermediaries, individuals interact directly with the system. Instead of requesting permission, they execute transactions independently. Instead of storing value within institutions, they hold it themselves. This shift is subtle at first. It feels technical, but over time, it changes the relationship between people and money. control becomes internal rather than external. Most people do not fully adopt this shift. They remain partially within the traditional system while experimenting with the new one. This creates a tension between two models, one based on managed trust, the other based on distributed verification. That tension is not resolved, it is expanding. And as it expands, it reveals the assumptions each system depends on. The traditional system assumes stability requires control. That without oversight, money becomes chaotic. Crypto challenges that assumption by showing that order can emerge from consensus rather than authority. Not perfect order, but functional order, enough to operate, enough to persist, enough to grow. This is not a theoretical shift. It is already happening, quietly, across millions of transactions. At the same time, institutions are adapting. Banks are exploring digital assets. Governments are researching central bank digital currencies. Payment networks are integrating blockchain elements. The system is not ignoring crypto. It is absorbing aspects of it while attempting to maintain control. This creates a hybrid environment where old structures and new technologies coexist, often uneasily. This is where identity becomes involved. People who believe they are being cautious by saving within traditional systems are aligning with a structure that limits flexibility. Those who avoid risk may be reinforcing dependence. Those who seek stability may be accepting reduced control. These behaviors are rational within the framework they understand. But that framework is shifting. The realization is not immediate. It builds slowly. Each delayed transaction, each unexpected restriction, each moment where access depends on approval. These are small signals. Individually, they seem insignificant. Collectively, they form a pattern that suggests money is no longer just a tool for exchange. It is a system of managed movement. Crypto does not eliminate this reality. It exposes it. By offering an alternative, it highlights the constraints of the existing system. It does not need to replace traditional money to have an impact. It only needs to exist as a comparison, and that comparison changes perception. Once seen, the difference is difficult to ignore. There is a cost to recognizing this, not immediate, but cumulative. Time spent operating within a system that reduces flexibility. Opportunities missed because access was limited. Value eroded by mechanisms that operate beyond individual control. These are not dramatic losses. They are gradual. And because they are gradual, they are rarely questioned. The longer the system remains unquestioned, the more embedded it becomes. Infrastructure builds around it. Policies reinforce it. Behavior adapts to it. Changing direction becomes harder, not because alternatives do not exist, but because the cost of shifting increases over time. This is how systems persist, not through perfection, but through integration. Crypto represents a different path, but not a simple one. It introduces new risks, new uncertainties, new forms of volatility. But those risks are visible. They are part of the system's surface. The risks in traditional finance are often hidden, embedded in structures that feel stable until they are not. This difference in visibility changes how risk is perceived. What emerges is not a clear choice between two systems, but a deeper question about what money actually is. Is it a stable store of value managed by institutions? Or is it a flexible medium of exchange controlled by individuals? Can it be both? Or does one form inevitably limit the other? These questions do not have immediate answers, but they are becoming harder to avoid. As more people encounter crypto, not just as an asset, but as a concept, the underlying assumptions of modern money are being examined. Quietly, individually, without coordination. This is not a sudden shift. It is a gradual one. And gradual shifts are often the most significant, because they change perception before they change structure. Once perception changes, behavior follows. Not all at once, not uniformly, but enough to alter the system over time. And when behavior changes, systems adjust. Sometimes by evolving, sometimes by resisting, but never by remaining completely the same. What crypto reveals is not just a new form of money. It reveals that the current form was never as fixed as it appeared. It was constructed, maintained, adjusted, and now questioned. That questioning is not loud. It does not need to be, because once it begins, it does not easily stop. And if money is ultimately a system of trust, then the question is no longer whether that trust exists, but where it is placed, how it is enforced, and who truly controls it when everything appears to be working. If you're interested in how money, incentives, and behavior really interact, you may want to follow Finance Simplified